Chapter 1: Introduction to Alternative Investments. Navigating the landscape of alternative investments, an in-depth exploration. In the ever-evolving world of finance, investors are increasingly seeking avenues that diverge from traditional stocks and bonds, exploring a diverse array of opportunities known as alternative investments. This expansive realm encompasses a spectrum of assets, strategies, and financial instruments that extend beyond the conventional confines of the stock market and fixed income securities. From real assets and private equity to financial derivatives, alternative income streams, and the enigmatic realm of cryptocurrencies, alternative investments provide a multifaceted landscape for those seeking to diversify their portfolios and potentially enhance returns. Defining alternative investments. Alternative investments, at their core, represent a departure from the conventional assets of stocks and bonds. This category includes a broad array of tangible and intangible assets, investment strategies, and financial instruments that often operate outside the realm of traditional public markets. Real assets like real estate, commodities and infrastructure, private equity and venture capital, financial derivatives, and emerging digital assets all find a place under the umbrella of alternative investments. What sets alternative investments apart is their potential to generate returns that exhibit lower correlation with traditional markets. This characteristic becomes particularly appealing in times of market turbulence, providing investors with a potential hedge against downturns. However, the allure of alternative investments comes hand in hand with increased complexity, unique risks, and the necessity for a nuanced understanding of each category within this diverse landscape. Historical context and evolution. To appreciate the significance of alternative investments, one must embark on a historical journey that highlights the evolution of financial markets. Traditionally, investors relied heavily on a combination of stocks and bonds to construct their portfolios. However, the latter half of the 20th century witnessed a seismic shift with the emergence of alternative investment options. The 1970s marked a pivotal moment with the introduction of hedge funds, entities employing strategies beyond traditional long-only approaches. These funds played a crucial role in popularizing the concept of alternative investments, offering a new dimension to portfolio diversification. Over subsequent decades, the landscape continued to expand, embracing private equity, real estate investment trusts, REITs, commodities, and other non-traditional assets. Structure of this exploration. This comprehensive exploration of alternative investments unfolds across distinct chapters, each dedicated to unraveling the intricacies of a specific category. From real assets and financial derivatives to private equity, alternative income streams, and the enigmatic world of cryptocurrencies, each section offers a deep dive into the characteristics, risks, and rewards associated with these diverse investment avenues. As we navigate this landscape, the overarching goal is to equip investors, both seasoned and newcomers, with the knowledge and insights necessary to make informed decisions. Whether one seeks to broaden an existing portfolio or comprehensively understand the intricacies of alternative investments, this journey serves as a comprehensive guide to the diverse universe beyond stocks and bonds. In the subsequent chapters, we will delve into the tangible realm of real assets, exploring the nuances of real estate ventures, precious metals, commodities, and more. The journey will then lead us through the complex terrain of financial derivatives, shedding light on options, futures trading, and risk management strategies. The landscape of private equity and venture capital will be explored in detail, providing a nuanced understanding of investing in private companies, venture capital opportunities, and the associated risks and rewards. Alternative income streams, including peer-to-peer lending, crowdfunding platforms, and fixed income alternatives, will be unraveled to reveal their potential in diversifying income sources. Finally, our journey will culminate in the enigmatic domain of cryptocurrencies and digital assets. An introduction to cryptocurrencies, the underlying blockchain technology, and the risks and opportunities in the digital asset space will provide a comprehensive understanding of this evolving frontier. As we embark on this exploration of alternative investments, it is crucial to recognize that each category within this vast landscape requires careful consideration. The goal is not only to unveil the potential benefits, but also to shed light on the complexities and risks inherent in each alternative investment avenue. By the journey's end, readers will be well equipped to navigate this dynamic landscape and make informed decisions aligned with their investment objectives and risk tolerances. The role of alternatives in a diversified portfolio. Central to the appeal of alternative investments is their role in constructing a diversified portfolio. Traditional asset classes often move in tandem, especially during periods of market stress. Alternatives, however, can exhibit different risk-return profiles, providing a potential hedge against market downturns. Diversification, the practice of spreading investments across different asset classes, is a cornerstone of risk management. By adding alternative investments to a portfolio, investors aim to achieve a more balanced risk-return profile. While alternative investments can introduce complexity and unique risks, their inclusion can enhance the potential for returns and contribute to overall portfolio resilience. Consider a portfolio comprised solely of stocks and bonds. During a market downturn, both asset classes may experience declines simultaneously. In contrast, a well-constructed portfolio incorporating alternative investments may demonstrate more resilience, as these assets may not move in lockstep with traditional markets. Moreover, the potential for enhanced returns is a driving force behind the integration of alternative investments. While these assets often come with higher risk, they also present opportunities for alpha generation, returns above and beyond what can be attributed to the broader market. In the subsequent chapters of this book, we will embark on a comprehensive exploration of various alternative investment categories. From real assets, financial derivatives, and private equity to alternative income streams and cryptocurrencies, each section will unravel the intricacies, risks, and rewards associated with these diverse investment avenues. As we navigate the landscape of alternative investments, the overarching goal is to equip investors with the knowledge and insights necessary to make informed decisions. Whether you are a seasoned investor looking to broaden your portfolio or a newcomer seeking to understand the intricacies of alternative investments, this journey aims to provide a comprehensive guide to the diverse world beyond stocks and bonds. Chapter 2: Real Assets: Investing in the Tangible. Exploring real estate ventures. An in-depth overview. Real estate, a tangible and versatile asset class, has long held a prominent place in investment portfolios. Beyond providing shelter, real estate ventures offer investors opportunities for income generation, capital appreciation, and portfolio diversification. In this comprehensive overview, we will delve into the multifaceted world of real estate ventures, exploring residential and commercial properties, real estate investment trusts, REITs, and the intricacies of navigating the dynamic real estate market. Residential real estate ventures. Single-family homes. Single-family homes represent a cornerstone of residential real estate investment. Investors can choose to purchase homes for rental income or capital appreciation. Rental properties offer a steady income stream through tenant payments, while property values may appreciate over time. Single-family homes are often considered a stable and accessible entry point for investors venturing into real estate. Multifamily units. Investing in multifamily units, such as apartment buildings or condominium complexes, provides scalability and diversification. Multifamily properties can generate multiple income streams through the rental of individual units. This approach allows investors to spread risk across multiple tenants and mitigate the impact of vacancies on overall income. Vacation rentals. The rise of platforms like Airbnb has expanded the landscape of residential real estate ventures to include vacation rentals. Investors can capitalize on the demand for short-term accommodations in tourist destinations. While this avenue offers higher income potential, it also comes with the challenges of seasonality, property management, and potential regulatory considerations. Commercial real estate ventures. Office spaces. Investing in office spaces involves owning or leasing properties used for business operations. The performance of office space investments is closely tied to economic trends and employment dynamics. Factors such as location, amenities, and lease terms influence the attractiveness of office properties to tenants and, consequently, their investment potential. Retail establishments. Retail real estate includes properties such as shopping malls, strip malls, and standalone stores. Retail investments are influenced by consumer spending patterns, population demographics, and the growth of e-commerce. Successful retail real estate ventures often hinge on strategic tenant selection and adapting to evolving consumer preferences. Industrial facilities. Industrial real estate, encompassing warehouses, distribution centers, and manufacturing facilities, plays a crucial role in the supply chain. The growth of e-commerce and changes in logistics have heightened the demand for well-located industrial properties. Investors in industrial real estate benefit from the increasing need for efficient storage and distribution facilities. Real estate investment trusts, REITs. Real estate investment trusts, REITs, provide a unique avenue for investors to access real estate ventures without direct property ownership. REITs are companies that own, operate, or finance income-generating real estate across various sectors. Investors can buy shares in publicly traded REITs, providing them with exposure to a diversified portfolio of real estate assets. Types of REITs. 1. Equity REITs. These REITs own and manage income-producing real estate properties. Income generated from rents and capital appreciation contributes to dividends distributed to shareholders. 2. Mortgage REITs. Mortgage REITs invest in mortgage-backed securities, generating income through interest payments. These REITs may be more sensitive to interest rate fluctuations. 3. Hybrid REITs. Hybrid REITs combine elements of both equity and mortgage REITs. They may own properties and hold mortgages in their portfolios. Advantages of REITs. 1. Liquidity. REIT shares can be bought and sold on stock exchanges, providing investors with liquidity compared to direct real estate ownership. 2. Diversification. REITs often hold a diversified portfolio of properties across different sectors and geographic locations, reducing risk. 3. Income potential. REITs are required to distribute a significant portion of their income as dividends to shareholders, making them attractive for income-focused investors. Risks and considerations in real estate ventures. Market conditions. Real estate markets are influenced by economic conditions, interest rates, and local factors. Economic downturns, rising interest rates, or oversupply in specific markets can impact property values and rental income. Property management. Direct real estate ownership requires effective property management. Investors must handle tasks such as tenant relations, property maintenance, and addressing legal and regulatory requirements. Professional property management can alleviate some of these challenges, but adds to the overall cost. Financing and leverage. Investors often use financing such as mortgages to acquire real estate. While leverage can amplify returns, it also increases risk, especially in volatile markets or when interest rates rise. Prudent financing strategies and stress testing are crucial considerations for real estate investors. Regulatory considerations. Real estate ventures are subject to various regulations, zoning laws, and property taxes. Changes in regulations can impact property values and the feasibility of certain types of real estate investments. Real estate ventures in a diversified portfolio. Diversification benefits. Including real estate ventures in a diversified investment portfolio can enhance overall risk-adjusted returns. Real estate's performance often exhibits low correlation with traditional asset classes, providing a potential hedge against market volatility. Potential for enhanced returns. Real estate ventures offer the potential for both income generation and capital appreciation. Well-selected properties in high-demand markets can yield attractive returns over the long term. However, this potential comes with the need for thorough research and due diligence. Navigating the real estate landscape. Real estate ventures, whether in residential, commercial, or REIT form, present investors with a rich tapestry of opportunities and challenges. The choice between direct ownership and indirect investment through REITs depends on individual preferences, risk tolerance, and investment goals. Navigating the real estate landscape requires a multifaceted approach. Investors must conduct thorough market research, assess property values, and consider the economic and regulatory environment. Additionally, staying informed about broader economic trends and demographic shifts can provide valuable insights for strategic real estate investment decisions. As with any investment, the key to success in real estate ventures lies in a combination of careful planning, risk management, and a long-term perspective. By understanding the nuances of residential and commercial real estate, as well as the dynamics of REITs, investors can harness the potential of this tangible asset class to build resilient and diversified investment portfolios. Precious metals and commodities. Exploring precious metals and commodities, a comprehensive overview. The world of alternative investments is vast and diverse, offering investors unique avenues to diversify their portfolios and seek returns beyond traditional assets. One particularly intriguing category within this landscape is the realm of precious metals and commodities. In this comprehensive overview, we will delve into the intricate dynamics of investing in precious metals and commodities, exploring their historical significance, investment strategies, and the role they play in a well-balanced portfolio. Historical significance of precious metals. Gold, a timeless store of value. Gold, often referred to as the king of metals, holds a unique place in human history. Beyond its aesthetic appeal, gold has served as a store of value for centuries. Dating back to ancient civilizations, gold was used as a medium of exchange and a symbol of wealth. Its scarcity, durability, and resistance to corrosion made it a reliable form of currency. In the modern era, gold continues to be a sought-after asset for investors. During times of economic uncertainty, gold tends to shine as a safe haven investment. Investors flock to gold as a hedge against inflation, currency fluctuations, and geopolitical risks. Central banks also hold significant gold reserves, further underscoring its role as a stabilizing force in the global financial system. Silver, platinum, and palladium. While gold takes the spotlight, other precious metals, silver, platinum, and palladium, play essential roles in various industrial applications. Silver, with its conductivity and antibacterial properties, finds use in electronics and healthcare. Platinum and palladium are crucial components in catalytic converters, contributing to the reduction of vehicle emissions. Investors interested in precious metals often diversify their portfolios by including not only gold, but also these other metals. Each metal carries its unique characteristics and drivers, providing opportunities for strategic investment decisions. Investment strategies in precious metals. Physical ownership versus exchange-traded funds, ETFs. Investors interested in precious metals face the decision of whether to own physical assets or invest through financial instruments like ETFs. Physical ownership involves purchasing and storing actual metal, whether in the form of coins, bars, or other tangible assets. This approach provides a sense of security and ownership, but requires storage and insurance considerations. On the other hand, ETFs offer a convenient way to gain exposure to precious metals without the logistical challenges of physical ownership. These funds typically track the performance of the metal's price, allowing investors to buy and sell shares on the stock market. Mining stocks and precious metal mutual funds. Beyond direct ownership and ETFs, investors can explore the world of mining stocks and mutual funds focused on precious metals. Investing in mining stocks involves purchasing shares of companies engaged in the extraction and production of precious metals. The performance of these stocks is influenced not only by metal prices, but also by the operational efficiency and exploration success of the mining companies. Precious metal mutual funds pool capital from multiple investors to invest in a diversified portfolio of mining stocks, ETFs, and sometimes physical assets. This approach provides a level of diversification and professional management, making it an attractive option for those seeking exposure to the sector without selecting individual stocks. Commodities, a broad investment spectrum. Commodities represent a broad category of tangible goods traded in various markets worldwide. From agricultural products to energy resources and metals, commodities play a pivotal role in the global economy. Investing in commodities provides opportunities for diversification and exposure to fundamental economic activities. Types of commodities. Energy commodities. Energy commodities, including oil, natural gas, and coal, are vital resources that power economies around the world. The prices of energy commodities are influenced by geopolitical events, supply and demand dynamics, and global economic trends. Investors often monitor energy markets for insights into the overall health of the global economy. Agricultural commodities. Agricultural commodities encompass a wide range of products, including grains, livestock, and soft commodities like cotton and coffee. The prices of agricultural commodities are influenced by factors such as weather conditions, global demand, and technological advancements in farming practices. Agricultural investments can provide a hedge against inflation and diversification benefits. Base metals and industrial commodities. Base metals, such as copper, aluminum, and zinc, are critical components in industrial processes and manufacturing. These commodities are sensitive to economic cycles, with demand closely tied to infrastructure development and manufacturing activities. Investing in base metals can offer insights into the health of industrial sectors and global economic growth. Precious metals as commodities. While precious metals like gold and silver are often considered separate from other commodities, they are in fact an integral part of the broader commodity market. Precious metals, with their dual roles as financial assets and industrial inputs, exhibit unique dynamics that set them apart from other commodities. Factors influencing commodities prices. Supply and demand dynamics. The fundamental forces of supply and demand play a central role in determining commodity prices. Natural disasters, geopolitical events, and shifts in global economic activity can impact the supply and demand for commodities. For example, disruptions in oil-producing regions can lead to fluctuations in oil prices, affecting both energy markets and the broader economy. Economic indicators and inflation. Commodity prices are sensitive to economic indicators and inflationary pressures. As economies grow, the demand for commodities, especially industrial ones, tends to increase. Additionally, commodities, often viewed as tangible assets, are sought after during periods of inflation as a hedge against eroding purchasing power. Currency movements. The value of commodities is often quoted in U.S. dollars. Therefore, currency movements can significantly impact commodity prices. A weakening dollar tends to make commodities more attractive to investors, potentially leading to an increase in prices. Investing in commodities, strategies, and instruments. Futures contracts. One common way to invest in commodities is through futures contracts. These contracts obligate the buyer to purchase or the seller to sell a specific quantity of a commodity at a predetermined price on a future date. Futures trading allows investors to speculate on price movements, hedge against potential price changes, and gain exposure to commodity markets. Exchange-traded funds, ETFs. Commodity ETFs offer a convenient way for investors to gain exposure to a diversified portfolio of commodities. These funds may hold physical commodities or invest in futures contracts. Commodity ETFs provide liquidity and flexibility, allowing investors to trade commodity markets without the complexities of direct commodity ownership. Commodity mutual funds. Similar to precious metal mutual funds, commodity mutual funds pool capital from multiple investors to invest in a diversified portfolio of commodity-related assets. These funds may invest in a combination of physical commodities, futures contracts, and related equities. Commodity mutual funds offer professional management and diversification benefits. Risks and challenges in precious metals and commodities investing. Price volatility. Commodities, including precious metals, are known for their price volatility. Factors such as geopolitical events, weather conditions, and shifts in global demand can lead to sudden and significant price movements. While volatility presents opportunities for profit, it also introduces the risk of substantial losses. Geopolitical and supply chain risks. Commodities often sourced from specific regions are susceptible to geopolitical risks and disruptions in the global supply chain. Political instability, trade tensions, and natural disasters can impact the production and transportation of commodities, affecting prices and market dynamics. Market liquidity. Certain commodities may experience lower liquidity compared to more traditional financial instruments. This lower liquidity can result in wider bid-ask spreads and challenges in executing trades, especially during times of market stress. Regulatory and environmental risks. Investors in commodities, particularly those related to energy and mining, face regulatory and environmental risks. Changes in regulations, environmental policies, or safety standards can impact the operations and profitability of companies involved in commodity extraction and production. Navigating the complex terrain. Precious metals and commodities represent a captivating corner of the alternative investment universe, offering investors avenues for diversification, hedging, and potential returns. The historical significance of precious metals, coupled with the broad spectrum of commodities influencing global economic activities, provides a rich tapestry for investors to explore. Navigating this complex terrain requires a nuanced understanding of market dynamics, risk factors, and the various instruments available for investment. Whether one chooses to invest directly in physical assets, explore mining stocks, or engage with ETFs and mutual funds, a strategic approach and diligent research are paramount. As investors increasingly recognize the importance of diversifying their portfolios, the role of precious metals and commodities in a well-balanced investment strategy continues to evolve. With careful consideration of risk tolerance, investment goals, and market conditions, investors can leverage the unique opportunities presented by precious metals and commodities to enhance the resilience and performance of their overall investment portfolios. The realm of collectibles and fine arts, a comprehensive exploration. The world of alternative investments unfolds like a tapestry of diverse opportunities, and among its rich threads, collectibles and fine arts stand out as a unique and captivating category. Beyond the traditional domains of stocks and bonds, this segment beckons investors with the allure of aesthetic value and the potential for financial appreciation. In this exploration, we delve into the intricate world of collectibles and fine arts, unraveling the nuances, risks, and rewards that characterize this captivating dimension of alternative investments. Defining collectibles and fine arts. Collectibles and fine arts, within the realm of alternative investments, encompass a wide spectrum of tangible assets valued for their aesthetic, cultural, and historical significance. This category extends beyond the financial realm, bridging the gap between the artistic and the economic. From rare coins, stamps, and vintage cars, to paintings, sculptures, and other artistic creations, the world of collectibles and fine arts is as diverse as it is fascinating. At its core, investing in collectibles and fine arts involves acquiring items with the expectation of their value appreciating over time. This appreciation can stem from factors such as rarity, provenance, cultural significance, and the shifting tastes of the market. Unlike traditional financial instruments, the value of these items is often subjective, shaped by the perceptions and preferences of collectors and connoisseurs. Historical significance and evolution. To grasp the significance of collectibles and fine arts as alternative investments, a journey into their historical context is essential. The concept of valuing and collecting art and artifacts dates back centuries, often driven by a combination of aesthetic appreciation and a desire to preserve cultural heritage. The Renaissance period, for instance, witnessed a surge in the collection of fine arts as a symbol of wealth and refinement. Over time, the notion of collecting expanded beyond aristocratic circles to encompass a broader audience. In the 20th century, the art market saw the emergence of renowned collectors, galleries, and auction houses, further shaping the dynamics of this unique investment category. Diverse categories within collectibles and fine arts. 1. Fine arts. Paintings. From classical masterpieces to contemporary works, paintings hold a central place in the world of fine arts investment. Renowned artists' works can command staggering prices at auctions and private sales. Sculptures. Three-dimensional artworks, ranging from classical sculptures to modern installations, contribute to the tapestry of fine arts investments. Material, form, and the artist's reputation influence their value. Photography. The photography market has gained prominence, with works by iconic photographers becoming sought-after collectibles. 2. Numismatics. Rare coins. Collecting rare coins, often with historical significance or unique features, is a niche within numismatics. The condition, rarity, and historical context contribute to their value. 3. Philately. Rare stamps. Philately, the collection and study of postage stamps, involves acquiring rare stamps with unique designs, historical importance, or printing errors. 4. Automobilia. Vintage cars. Beyond transportation, vintage cars are prized as collectibles. Rarity, historical significance, and meticulous preservation contribute to their value. 5. Memorabilia. Sports memorabilia. Autographed sports items, game-worn jerseys, and memorabilia from iconic moments in sports history attract collectors seeking tangible connections to their favorite athletes and teams. Entertainment memorabilia. Items related to film, music, and pop culture, such as costumes, props, and autographed items, hold value for enthusiasts and investors alike. Investment dynamics and considerations. Investing in collectibles and fine arts requires a unique set of considerations due to the subjective nature of their valuation and the diverse categories within this segment. 1. Research and expertise. Art market trends. Understanding the trends in the art market is crucial. This involves staying informed about the works of emerging artists, shifts in taste, and the performance of specific genres or periods. Authentication and appraisal. Verifying the authenticity of artworks and obtaining professional appraisals are essential steps. Expertise from art historians and appraisers ensures a thorough understanding of an item's provenance and value. 2. Market dynamics. Auction houses. Major auction houses play a significant role in the art market. Sales results and price trends from auctions provide valuable insights into market dynamics. Gallery relationships. Building relationships with reputable galleries and dealers can offer access to exclusive artworks and insights into emerging artists. 3. Storage and maintenance. Preservation. The physical condition of collectibles is paramount. Proper storage conditions, protection from environmental factors, and preventive measures against deterioration are crucial for maintaining value. Insurance. Given the often high value of collectibles and fine arts, securing comprehensive insurance coverage is a prudent measure against potential losses due to theft, damage, or unforeseen events. 4. Diversification. Portfolio allocation. Integrating collectibles into an investment portfolio requires careful consideration of overall asset allocation. Diversification across different categories can mitigate risks associated with the volatility of specific markets. 5. Liquidity challenges. Illiquidity. Unlike traditional financial assets, selling collectibles may not be as straightforward. The illiquid nature of certain items means that converting them into cash can be a time-consuming process. Risks and rewards. 1. Risks. Market volatility. The value of collectibles and fine arts can be subject to market trends and economic conditions, leading to potential volatility. Subjectivity and valuation. The subjective nature of aesthetic value and the reliance on individual preferences make valuation challenging and sometimes speculative. Authenticity concerns. The risk of acquiring fake or misrepresented items is inherent in the art market, emphasizing the need for thorough authentication processes. 2. Rewards. Potential appreciation. Successful navigation of the art market can lead to significant appreciation in the value of collectibles and fine arts. Intrinsic enjoyment. Beyond financial returns, collectors often derive intrinsic enjoyment from owning and appreciating the artistic and historical value of their acquisitions. Diversification benefits, including collectibles in a diversified portfolio, can provide a unique avenue for diversification, potentially offering a hedge against market downturns. Future trends and innovations. The landscape of collectibles and fine arts continues to evolve, influenced by technological advancements, changing demographics, and global trends. Some notable developments include 1. Digital art and NFTs, digital collectibles. The rise of digital art and non-fungible tokens, NFTs, has introduced a new dimension to the art market. NFTs represent ownership of digital assets and have gained traction as a form of investment and collection. 2. Technological integration, augmented reality, AR. Technological innovations such as AR are enhancing the way collectors experience art. Virtual exhibitions and the ability to visualize artworks in different settings contribute to the evolving landscape. 3. Globalization and access. Online platforms. The proliferation of online platforms has expanded access to the art market, allowing collectors to participate in auctions, purchase artworks, and engage with the global art community. The realm of collectibles and fine arts within the broader landscape of alternative investments offers a captivating blend of aesthetic appreciation and financial potential. As investors navigate this unique segment, a nuanced understanding of the diverse categories, market dynamics, and associated risks and rewards becomes paramount. The historical significance of collecting, the evolution of markets, and the fusion of art and finance contribute to the enduring appeal of collectibles and fine arts as alternative investments. Whether one seeks to invest in classical paintings, rare coins, or contemporary digital art, the journey involves a delicate balance of passion, research, and financial acumen. As we conclude this comprehensive exploration, the tapestry of collectibles and fine arts invites investors to appreciate the intrinsic and extrinsic values woven into each piece. From the strokes of a masterful painting to the historical imprints on rare coins, these investments beckon with the promise of a unique and enriching journey, one that transcends the conventional boundaries of financial portfolios and ventures into the realm where art, history, and finance converge. Navigating the landscape of infrastructure and natural resources, an alternative investment odyssey. In the vast realm of alternative investments, infrastructure and natural resources emerge as compelling and multifaceted categories, offering investors a tangible connection to the fundamental elements that underpin human civilization. This exploration delves into the intricacies of investing in infrastructure projects and natural resources, unraveling the diverse opportunities, challenges, and the vital role these assets play in shaping economic landscapes globally. Defining infrastructure and natural resources. Infrastructure and natural resources within the realm of alternative investments encompass a spectrum of tangible assets crucial for the functioning and development of societies. Infrastructure projects, ranging from toll roads and airports to energy facilities, form the backbone of modern civilization. Natural resources, on the other hand, include essential elements such as timber, water rights, and agricultural land that sustain life and economic activities. The allure of investing in infrastructure lies in the potential for stable, long-term returns, often backed by the demand for essential services and the involvement of governments. Natural resources, with their intrinsic value and role in various industries, offer investors a unique avenue for diversification and participation in global supply and demand dynamics. Infrastructure investments, building the foundation. Toll roads and transportation infrastructure. Toll roads stand as quintessential examples of infrastructure investments. These assets generate revenue through toll collections from users and often offer stable cash flows. Investors in toll roads gain exposure to the ongoing demand for efficient transportation networks, particularly in regions experiencing population growth and urbanization. Transportation infrastructure, beyond toll roads, encompasses investments in airports, ports, and railways. These assets play a vital role in facilitating the movement of goods and people, and their investment dynamics are influenced by factors such as regional economic growth, trade patterns, and government policies. Energy facilities and utilities. Investing in energy facilities involves participation in projects related to power generation, including renewable energy sources such as solar and wind farms, as well as traditional energy sources like natural gas and hydroelectric power. The push towards sustainable and clean energy solutions has brought renewable energy infrastructure to the forefront of investment considerations. Utilities, including water and sewage treatment facilities, are essential components of infrastructure investments. These assets provide vital services to communities, and their investment appeal lies in the recurring revenue streams generated from the provision of essential services. Risks and considerations in infrastructure investments. While infrastructure investments offer stability and long-term returns, they are not without risks. Factors such as regulatory changes, political stability, and shifts in demand patterns can impact the performance of these assets. robust due diligence, understanding the regulatory environment, and assessing the resilience of the underlying projects are crucial for investors navigating the landscape of infrastructure investments. Natural resource investments sustaining civilization. Timber and forest investments. Investing in timber and forests involves acquiring land with timber resources or investing in timberland investment management organizations, TIMOs. Timber, a renewable resource, holds value for its use in construction and various industries. Timberland investments offer a unique combination of capital appreciation and a recurring income stream through sustainable harvesting practices. Water rights and agricultural land. Water rights investments involve acquiring rights to use or access water resources. As water scarcity becomes an increasing global concern, investing in water rights gains importance. Agricultural land investments, on the other hand, provide exposure to the fundamental sector of food production. The value of agricultural land is influenced by factors such as soil quality, climate, and the global demand for food. Mining and natural resource exploration. Investing in mining involves participating in projects related to the extraction of valuable minerals and resources. This includes precious metals like gold and silver, industrial metals like copper and aluminum, and strategic minerals used in various industries. Natural resource exploration extends beyond traditional mining to include the search for new resource deposits and reserves. Risks and rewards in natural resource investments. Natural resource investments are subject to a range of risks, including commodity price volatility, environmental considerations, and geopolitical factors. The cyclical nature of commodity markets means that the performance of these assets can be influenced by global economic conditions. Additionally, environmental and sustainability concerns are increasingly shaping the landscape of natural resource investments, with investors placing greater emphasis on responsible and ethical practices. Integration into diversified portfolios. The inclusion of infrastructure and natural resource investments in diversified portfolios can offer investors a range of benefits. These assets often exhibit low correlation with traditional financial markets, providing a potential hedge against economic downturns. The stable, income-generating nature of many infrastructure investments can contribute to portfolio resilience, particularly during periods of market stress. Trends and developments in infrastructure and natural resource investments. The landscape of infrastructure and natural resource investments is dynamic, with several trends shaping the future of these asset classes. Rise of ESG, environmental, social, and governance investing. ESG considerations have gained prominence in the investment landscape, influencing decision-making across various sectors, including infrastructure and natural resources. Investors increasingly prioritize projects and companies that demonstrate strong environmental stewardship, social responsibility, and robust governance practices. Technology and innovation. Advancements in technology play a pivotal role in reshaping how infrastructure and natural resource investments are approached. Technologies such as remote sensing, data analytics, and automation contribute to more efficient resource exploration, sustainable practices, and the monitoring of infrastructure assets. Sustainable and impact investing. Investors are showing a growing interest in sustainable and impact investing within the infrastructure and natural resource space. This involves allocating capital to projects and companies that not only deliver financial returns, but also contribute positively to environmental and social outcomes. Infrastructure and natural resource investments offer a tangible connection to the foundational elements of human civilization. From the roads we travel to the water we drink and the resources that power industries, these assets form the backbone of societies. As alternative investments, they present unique opportunities for diversification, stable income, and participation in essential sectors. Navigating the landscape of infrastructure and natural resource investments requires a nuanced understanding of the specific dynamics within each category. From the regulatory considerations of infrastructure projects to the cyclical nature of commodity markets, investors must approach these assets with diligence and a long-term perspective. As we conclude this odyssey through the realm of alternative investments, infrastructure and natural resources stand as pillars of stability, and drivers of progress. In an ever-evolving world, the enduring demand for essential services and resources positions these assets as integral components of resilient and diversified investment portfolios. From the forests to the mines, and the roads to the renewable energy farms, the journey through infrastructure and natural resource investments is a journey into the very foundations of our interconnected global civilization. Chapter 3: Financial Derivatives and Risk Management. Options and Futures Trading. Financial derivatives, characterized by contracts whose value is derived from an underlying asset, play a pivotal role in alternative investments. This chapter focuses on two prominent types: options and futures. Options trading. Options grant investors the right, but not the obligation, to buy or sell an asset at a predetermined price within a specified time frame. This flexibility makes options valuable tools for speculation, hedging, and generating income. Speculation. Traders can use options to speculate on price movements. Call options allow betting on an asset's price increase, while put options enable speculation on a price decrease. Hedging. Investors utilize options to hedge against potential losses in their portfolios. For instance, a portfolio manager concerned about a market downturn might purchase put options to offset potential declines in asset values. Futures trading. Futures contracts obligate parties to buy or sell an asset at a predetermined price on a specified future date. Common in commodities, currencies, and financial instruments, futures provide a means of managing risk and gaining exposure to various markets. Speculation. Traders can leverage futures contracts to speculate on the future price movements of underlying assets, aiming to profit from anticipated market trends. Risk management. Businesses and investors use futures contracts to mitigate risks associated with price volatility. For example, a company reliant on a commodity may use futures to lock in prices, providing cost predictability. Hedging and speculation strategies. Hedging. Hedging involves using financial instruments to offset potential losses in existing investments. This risk management strategy is crucial in volatile markets, where unforeseen events can impact portfolio values. Portfolio hedging. Investors may use options or futures to hedge an entire portfolio against market downturns. This involves taking positions that would profit if the broader market faces declines. Currency hedging. Businesses engaged in international trade often use derivatives to hedge against currency fluctuations, reducing the risk of adverse exchange rate movements. Speculation strategies. While derivatives are powerful tools for risk management, they are equally valuable for speculation, allowing investors to capitalize on market opportunities. Long and short positions. Investors can take long, buying, or short selling positions using derivatives, depending on their market outlook. Long positions benefit from asset price increases, while short positions profit from price declines. Spread strategies. Options traders may employ spread strategies, involving the simultaneous purchase and sale of multiple options contracts, to capitalize on price differentials. Understanding market volatility. Volatility, a measure of the magnitude of price fluctuations, is a critical factor in derivatives trading. This section explores the dynamics of market volatility and its impact on options pricing. Implied versus historical volatility. Implied volatility reflects market expectations for future price movements, impacting options prices. Historical volatility, on the other hand, measures past price fluctuations. Volatility Index, VIX, often referred to as the Fear Index. VIX gauges market sentiment and expected volatility. Traders use VIX to assess the market's risk perception. Volatility trading strategies. Traders may adopt volatility trading strategies, such as straddles and strangles, to capitalize on anticipated changes in market volatility. Navigating the complex world of financial derivatives requires a nuanced understanding of these instruments' mechanics, risk profiles, and strategic applications. As we progress through this chapter, we will delve deeper into specific examples, case studies, and practical considerations for investors engaging in options and futures trading. Chapter 4: Private Equity and Venture Capital. Investing in Private Companies. Private equity and venture capital are dynamic segments of the alternative investments landscape, offering investors unique opportunities and challenges. This chapter explores the intricacies of investing in private companies, from early-stage startups to mature enterprises. Private equity. Private equity involves investing in non-publicly traded companies. Typically, private equity firms acquire a significant stake in a company, aiming to improve its performance and profitability before eventually exiting the investment. Leveraged buyouts. Private equity firms often engage in leveraged buyouts, acquiring companies using a combination of equity and debt. The goal is to enhance the target company's value over time through strategic initiatives. Long-term focus. Private equity investments are characterized by a longer investment horizon compared to publicly traded stocks. This extended time frame allows for comprehensive operational improvements and strategic shifts. Venture capital opportunities. Venture capital, VC. Venture capital focuses on investing in early-stage companies with high growth potential. Venture capitalists provide funding to startups in exchange for equity, playing a pivotal role in fostering innovation and entrepreneurship. Seed funding and series rounds. VC investments are often structured through seed funding and subsequent series rounds, Series A, B, C, etc., each representing a stage of a startup's growth. Risk and reward. Venture capital investments are inherently risky due to the uncertain success of early-stage ventures. However, successful exits, such as initial public offerings, IPOs, or acquisitions, can yield substantial returns. Risks and rewards in private equity. Risk factors. Private equity and venture capital investments come with their share of risks, including illiquidity. Unlike publicly traded stocks, private equity investments are less liquid. Investors may have limited opportunities to sell their stakes before an exit event. Operational risks. Private equity firms actively participate in the management of portfolio companies, exposing them to operational challenges and industry-specific risks. Rewards. Despite the risks, private equity investments offer several potential rewards. Enhanced returns. Successful turnarounds and strategic initiatives can lead to substantial returns, outperforming traditional asset classes. Diversification. Private equity provides an opportunity to diversify a portfolio beyond publicly traded securities, potentially improving overall risk-adjusted returns. Impact on portfolio performance. Diversification benefits. Integrating private equity and venture capital into a diversified portfolio can enhance overall performance. Low correlation. Private equity returns may exhibit low correlation with traditional asset classes, providing diversification benefits, particularly during economic downturns. Potential alpha generation. Skilled private equity managers may generate alpha by actively managing and improving the performance of portfolio companies. The evolving landscape. Trends and developments. The private equity and venture capital landscape continues to evolve, with notable trends including rise of ESG, environmental, social, and governance. Investing. Increasing emphasis on ethical and sustainable investing practices in the private equity space. Technology and innovation. Continued focus on technology-driven investments, with sectors such as fintech, biotech, and artificial intelligence attracting substantial funding. Navigating the realm of private equity and venture capital requires a nuanced understanding of the investment strategies, risk factors, and potential rewards associated with these dynamic asset classes. As we progress through this chapter, we will delve into real-world examples, case studies, and practical considerations for investors looking to incorporate private equity and venture capital into their portfolios. Chapter 5. Alternative Income Streams, Debt-Based Investments. Peer-to-peer lending. Peer-to-peer, P2P, lending has emerged as a disruptive force in the financial industry, offering individuals the opportunity to lend and borrow directly without the need for traditional financial intermediaries. This chapter explores the dynamics of P2P lending and its role as an alternative income stream. How P2P lending works. P2P lending platforms connect borrowers with individual lenders. Borrowers, often seeking personal loans or business funding, create loan listings detailing their borrowing needs. Investors then review these listings and choose loans to fund, earning returns through interest payments. Risk and returns. P2P lending presents a unique risk-return profile. While investors can earn attractive yields, the lack of collateral and the potential for borrower default introduce risks that must be carefully considered. Crowdfunding platforms. Crowdfunding platforms have democratized access to a diverse range of investment opportunities, allowing individuals to participate in funding projects, startups, and real estate ventures. This section explores the various forms of crowdfunding and their potential benefits and risks. Equity crowdfunding. Equity crowdfunding allows investors to purchase shares or ownership stakes in startups and small businesses. This model provides individuals with the chance to invest in early-stage companies and share in their potential success. Diversification opportunities. Equity crowdfunding enables investors to build diversified portfolios of early-stage investments, though it comes with the inherent risks associated with startup ventures. Real estate crowdfunding. Real estate crowdfunding platforms facilitate collective investment in real estate projects, from residential developments to commercial properties. Investors can participate in real estate opportunities with lower capital requirements compared to traditional real estate investments. Access to professional management. Real estate crowdfunding platforms often involve professional management, mitigating the need for individual investors to navigate the complexities of property management. Fixed income alternatives. Fixed income alternatives provide investors with options beyond traditional bonds to generate income. This section explores various fixed income alternatives, each with its unique characteristics. Preferred stocks. Preferred stocks combine elements of both equity and debt, offering investors a fixed dividend similar to bond interest. These stocks typically have a higher claim on assets and earnings than common stocks. Income and stability. Preferred stocks can provide a stable income stream and may be less volatile than common stocks. However, they still carry some level of risk, especially in economic downturns. Convertible securities. Convertible securities, such as convertible bonds, allow investors to receive interest income while retaining the option to convert the security into common stock. This hybrid nature provides both income and potential equity participation. Balancing risk and reward. Convertible securities offer a way to balance the desire for income with the potential for capital appreciation if the underlying stock performs well. Navigating the landscape. Risk management in alternative income streams. While alternative income streams offer diversification and income potential, they also come with specific risks. Managing these risks requires careful consideration and due diligence. Due diligence. Thorough research into the investment platforms, underlying assets, and associated risks is crucial. Understanding the terms and conditions of each investment is paramount for making informed decisions. Portfolio allocation. Integrating alternative income streams into a well-diversified portfolio requires thoughtful allocation. Balancing risk and return objectives is essential to achieving a robust and resilient income-generating portfolio. As we traverse the landscape of alternative income streams, this chapter aims to provide a comprehensive understanding of the opportunities and challenges associated with P2P lending, crowdfunding, and fixed income alternatives. Through case studies and practical insights, investors can gain the knowledge needed to navigate and leverage these alternative income sources effectively. Navigating cryptocurrencies and digital assets, a comprehensive exploration. The world of finance has undergone a profound transformation with the advent of cryptocurrencies and digital assets. This comprehensive exploration delves into the fundamentals of this innovative asset class, unraveling the intricacies of blockchain technology, the diverse landscape of cryptocurrencies, and the evolving role of digital assets in the global investment space. Blockchain technology, the foundation of cryptocurrencies. At the core of cryptocurrencies lies blockchain technology, a decentralized, distributed ledger that records transactions across a network of computers. This section provides a detailed examination of the key components and principles that define blockchain technology. Decentralization and trustless transactions. Blockchain eliminates the need for intermediaries, enabling peer-to-peer transactions without reliance on centralized authorities. This decentralization fosters trustless interactions, where participants do not need to trust each other, but rather the underlying technology. Cryptocurrencies as digital assets. Cryptocurrencies are digital or virtual assets that use cryptography for security. Bitcoin, the first and most well-known cryptocurrency, introduced the concept of a decentralized digital currency. This section explores the diverse universe of cryptocurrencies, including alternative coins, altcoins, and their various use cases. Diverse use cases. Beyond serving as a medium of exchange, cryptocurrencies have diverse applications. Some, like Ethereum, facilitate smart contracts and decentralized applications, dApps, while others focus on privacy or scalability. This section provides insights into the functionalities and unique features of prominent cryptocurrencies. Blockchain technology and its applications. The applications of blockchain technology extend far beyond cryptocurrencies. This section explores two pivotal aspects: smart contracts and the burgeoning field of decentralized finance, DeFi. Smart contracts. Smart contracts are self-executing contracts with terms directly written into code. Built on blockchain platforms like Ethereum, they automate and enforce contract execution, reducing the need for intermediaries. Decentralized finance, DeFi. DeFi leverages blockchain technology to provide financial services without traditional intermediaries. This encompasses lending, borrowing, trading, and more. The section delves into the opportunities and challenges associated with the DeFi ecosystem. Non-fungible tokens, NFTs. Non-fungible tokens, NFTs, represent unique, indivisible assets on the blockchain. Often associated with digital art and collectibles, NFTs have expanded into various industries. This section explores the concept of NFTs and their role in establishing digital ownership and authenticity. Risks and opportunities in the digital asset space. Investing in cryptocurrencies and digital assets presents a unique set of risks and opportunities. This section outlines key considerations for investors, including volatility and market risks, security considerations, and the evolving regulatory landscape. Volatility and market risks. Cryptocurrency markets are known for their volatility, with prices subject to rapid and substantial fluctuations. Understanding the factors influencing market dynamics is crucial for investors navigating this space. Security considerations. Security is a paramount concern in the digital asset space. Cryptocurrencies are stored in digital wallets, and the secure management of private keys is essential for preventing unauthorized access and potential theft. This section explores the different types of wallets and security considerations. Navigating regulatory landscape and investor education. The regulatory landscape for cryptocurrencies is evolving, with governments worldwide grappling to establish frameworks. Understanding and staying abreast of regulatory developments is crucial for investors operating in this space. The section also emphasizes the importance of investor education and due diligence in making informed investment decisions. Diversification and risk management. Cryptocurrencies can be a volatile asset class, and prudent risk management is essential. This section explores strategies for diversification across different cryptocurrencies and traditional asset classes to mitigate the inherent volatility. The future landscape of cryptocurrencies. As cryptocurrencies and digital assets continue to shape the financial landscape, several trends and developments are influencing their trajectory. This section provides insights into the future landscape of digital assets. Institutional adoption. Institutional interest in cryptocurrencies has grown, with prominent companies and financial institutions entering the space. This trend suggests a potential shift toward broader acceptance and integration of digital assets into traditional finance. Technological advancements. Ongoing technological advancements, such as blockchain scalability solutions and consensus algorithm improvements, aim to address current limitations. These developments may enhance the overall utility and efficiency of blockchain networks. Emerging use cases. Cryptocurrencies continue to find new applications, ranging from decentralized identity solutions to supply chain management. As these use cases mature, the value proposition of blockchain technology expands. Closing remarks. Navigating the complex and evolving landscape of cryptocurrencies and digital assets requires a multifaceted approach. This comprehensive exploration aims to equip investors with a comprehensive understanding of the technology, applications, risks, and opportunities associated with this innovative asset class. From the foundational principles of blockchain technology to the diverse universe of cryptocurrencies and the emerging trends shaping their future, this journey through the digital asset space provides valuable insights for investors, whether they are seasoned participants or newcomers to the world of cryptocurrencies. As we conclude this exploration, the overarching goal is to empower individuals to navigate the intricacies of investing in cryptocurrencies and digital assets effectively. The transformative potential of blockchain technology and the dynamic nature of this space underscore the importance of continuous learning and adaptation. Whether as a means of financial inclusion, a driver of technological innovation, or a portfolio diversification tool, cryptocurrencies and digital assets have undoubtedly secured their place in the ever-evolving landscape of global finance.